Understanding different loans type. Investopedia. Personal loans, credit cards come with high interest rates but do not require collateral. Home equity loans, low rates but the borrower's home. Understanding type of loan. Choose the one that best suits your financial situation. Personal loans, credit cards, home equity lines of credit. Borrowed money can be used for many purposes, from funding a new business to buying your fiancé an engagement ring. But with all of the different types of loans out there, which is best and for which purpose? Below are the most common types of loans and how they work. Key takeaways. Personal loans and credit cards come with high interest rates but do not require collateral. Home equity loans have low interest rates but the borrower's home serves as collateral. Cash advances typically have very high interest rates plus transactions fee. Personal loans. Most banks online and on Main Street offer personal loans and the proceeds may be used for virtually anything from buying a new 4K 3D smart TV to paying bills. This is an expensive way to get money because the loan is unsecured, which means that the borrower does not put up collateral that can be seized in case of default. As with a car loan or home mortgage, typically a personal loan can be obtained for a few hundred to a few $1,000s with repayment periods of 2 to 5 years. Borrowers need some form of income verification and proof of assets worth at least as much as the amount being borrowed. The application is typically only a page or two in length, and the approval or denial is generally best and worst rates. The average interest rate for a 24-month commercial bank loan was 10.21% in the fourth quarter of 2029. According to the Federal Reserve, but interest rates can be more than three times that amount once APR range from 9.95% to 35.99%. The best rates can only be obtained by people with exceptional credit ratings and substantial assets. The worst must be endured by people who have no other choice. A personal loan is probably the best way to go for those who need a borrower relatively small amount of money and are certain they can repay it within a couple of years. A personal loan calculator can be a useful tool for determining what kind of interest rate in is within your means. Bank loan versus bank guarantee. A bank loan is not the same as a bank guarantee. A bank may issue a guarantee as surety to third party on behalf of one of its customers if the customer fails to fulfill the relevant contractual obligation with a third party. That party can demand payment from the bank. The guarantee is typically an arrangement for a bank's small business clients. A corporation may accept a contractor's bid, for example, on the condition that the contractor's bank issues a guarantee of payment in the event that the contractor defaults on the contract. Important, a personal loans might be best for someone who needs to borrow a relatively small amount of money and is sure of their ability to repay it within a couple of years. Credit cards. Every time a consumer pays off with a credit card, it is effectively equivalent to taking out a small personal loan if the balance is paid in full immediately. No interest is charged. If some of the debt remains unpaid, interest is charged every month until it is paid off. The average credit card interest rate carried a 16.88% APR at the end of the fourth quarter of 2009, according to the Federal Reserve, down slightly from the 2019 second quarter rate 17.14, but almost exactly where it was at the end of the fourth quarter. Penalty rates for consumer who miss a single payment can get bumped even higher to 31.49 on at least two of HSBC Mastercard revolving credit card are extremely convention, and they require self-discipline to avoid overindulging. Studies have shown that consumers are more willing to spend when they use plastic instead of cash. A short one-page application process make it an even more convenient way to get $5,000 to $10,000 worth of credit home equity loans. People who own their own homes can borrow against the equity they have built up in them. That is, they can borrow up to the amount that they actually own. If half of the mortgage is paid off, they can borrow half of the value of the house. Or if the house has increased in value by 50%, they can borrow that amount. In short, the difference between the home's current fair market value and the amount still owed on the mortgage is the amount that can be borrowed. Low rates, bigger risk. An advantage of the home equity loan is that the interest rate charge is far lower than for a personal loan. According to a survey conducted by ValuePengun.com, the average interest rate for a 15-year fixed rate home equity loan as of February 5, 2020 was 5.88, and as a result of changing into 2017 Tax Cuts and Jobs Act, interest on a home equity loan is now only tax deductible if the money borrowed is used to buy, build, or substantially improve the taxpayer's home, and that secures the loan per the IRS. The biggest potential downside is that the house is the collateral for the loan. The borrower can be lose the house in case of default on the loan. The proceeds of a home equity loan can be used for any purpose, but they are often used to upgrade or expand the home. Thank you.